All right, I see that people are trickling in, so we'll go ahead and get started. Hi again, everyone. My name is Samir Varma. I'm a partner in Thompson Hine's International Trade Practice Group based here in Washington, D.C. Joining me today is Mark Butcha, a partner in Thompson Hine's Antitrust Practice, Joanna Redelbach, counsel in Van Bell & Bellis' International Trade Practice, and Andreas Reindl, managing partner of Van Bell & Bellis', as well as a member of their competition practice. Before we get started, I have just a couple housekeeping items, and then we'll dive into the substance. First of all, today's program is being recorded. We will send a link to all attendees within 48 hours of today's presentation, so you'll have that in your inbox. The presentation, and this is our disclaimer, presentation is intended for the general information of individuals and organizations on matters of current interest. The thoughts and opinions being expressed today are those of the individual panel members only and do not necessarily reflect the opinions of the panel members' clients, employers, affiliates, Thompson Hine, Van Bell & Bellis, etc. The content should not be taken as advice, as the views expressed are for informational purposes only. If you have any questions during the webinar, please feel free to use the question box located in the control panel on your screen, on the right side of your screen, to submit your questions. We will answer as many of the questions as we can, both during the presentation and at the end of the webinar. If we don't get to your questions, we'll certainly follow up after the program by email or phone. Finally, in the handout panel, you can download a copy of today's PowerPoint slides, as well as bios of today's speakers, of all four of us. Again, thanks for your interest, and we'll go ahead and get started. So obviously you've come here today to listen about regulatory compliance for multinationals as it relates to environmental, social, and governance matters or considerations. We're really tackling this from two perspectives, from international trade and from antitrust. Obviously, there's a lot to discuss. Can't do it all in such a short period of time, but we thought we'd touch upon some highlights and various points from a US and EU perspective. So first, Joanna and I are going to tackle international trade considerations. I wanted to start off by basically talking from the US perspective, just about the US government's goals regarding trade and ESG. There's various priorities that the government has talked about. The two that I wanted to discuss first was promoting environmental sustainability in supply chains, especially those related to renewable energy sources. Whenever it comes to international trade, the U.S. and ESG, the U.S. is constantly considering the climate crisis, but they're also thinking about remaining economically competitive and addressing national security concerns. Whenever we talk national security concerns, we're really focused on China. And as the U.S. knows, and as everybody knows, China has aggressively subsidized its green energy sector. The country has become a significant manufacturer of green goods. For example, on the renewable energy technology front, China is the world's leading producer of solar panels, wind turbines, batteries for electric vehicles. Many green technologies and materials like rare earth elements are sourced or processed in China. And so the U.S. has a real interest in trying to combat this from a national security perspective, while also promoting our own economic competitiveness. One of the ways that they did this was the Inflation Reduction Act back in 2022, which included a domestic content bonus, which basically meant any renewable energy projects, other clean energy investments could receive a bonus in available tax credits if they used a specified percentage of domestically produced goods and materials. Those percentages vary over the years, but it really depends on the type of project, whether it's solar or wind. Then if it's solar or wind, they look to the amount of US ordered steel and iron. Obviously electric vehicles and other EV infrastructure projects look to the batteries and battery components, etc. But this has really changed the game for US domestic producers and trying to combat what is, the looming China problem from a national security perspective. The second area that the U.S. is really focused on is encouraging sustainable investment through electric vehicles. I had mentioned just now that in the IRA, of the Inflation Reduction Act, there is a tax credit for EVs that are manufactured or have final assembly in North America. Now, there's a number of conditions related to the battery components, critical minerals production, et cetera, and what percentages must be manufactured domestically. And actually, over the years, that percentage is going to increase. But again, this really is what the U.S. is focused on, building sort of the supply chain sort of away from China into other sort of friend-shoring countries, as well as domestically here in the United States. There has been considerable debate about this and about what those percentages are, whether or not any of the products or any of the components can come from foreign entities of concern, China, Russia, Iran, North Korea, et cetera. But this is something that the U.S. is really focused on, and I don't see really that changing very much over the years. So again, two main goals for the United States, and then I think we'll go right to the EU. Joanna.
Thank you, Samir. Now, on the other side of the Atlantic, in the EU, there have been quite many developments in the recent years relating to the supply chain due diligence obligations. And some of the considerations in the EU are similar to those that Samir have just outlined. But as some of you may know, the EU has recently adopted several different pieces of legislation setting out various corporate due diligence rules. And these rules in general are largely based on already existing voluntary due diligence schemes, such as the OECD due diligence guidance for responsible business conduct. But unlike those schemes, they lay down mandatory rules and are accompanied by dedicated enforcement mechanisms. One of the main drivers for the EU to adopt these rules, in addition to the general sustainability considerations, was the risk of the fragmentation of the EU single market. So several EU member states, including Germany and France, adopted national due diligence rules. And in order to avoid that companies that are active in the EU will have to comply with different rules in different parts of the EU, and to ensure a level playing field across the bloc, the EU decided to adopt a harmonized set of rules. Now, these new supply chain due diligence rules can be generally divided into horizontal rules, such as the Corporate Sustainability Due Diligence Directive, or the CSDDD, as we call it in Brussels, and sectoral rules, if you will, which relate either to specific products, such as the batteries regulation, or which relate to specific issues, such as the forced labor regulation or the deforestation regulation. Now, in addition to that, although this will not be the focus of discussion today, there is a Corporate Sustainability Reporting Directive, the CSRD, which, although it does not deal specifically with due diligence as such, it imposes certain transparency and reporting obligations which relate to companies' due diligence policies. What is relevant is that all these different set of rules apply in parallel, which means that companies should take more holistic compliance approach, and rather than focusing on individual pieces of legislation, try to really first determine which rules are relevant and how they may interact with each other. Generally speaking, the CSDDD provides for a horizontal framework for supply chain due diligence, which relates both to the environment and human rights, and it applies to very large EU and non-EU companies. It is complemented by the more specific rules which are set out in the sectoral instruments, such as the deforestation regulation or the forced labor regulation. And there's also a certain overlap in terms of the reporting requirements. So for instance, the CSRD requires reporting on sustainability matters, which includes information about forced labor in the value chain. So in that sense, there's a relationship between the CSRD and the forced labor regulation. And likewise, the CSDDD largely relies on the reporting under the CSRD. So I know it's a lot of information at once, but all that to say that these different set of rules interact with each other, so they should not be seen in isolation and must be considered together as part of a more integrated EU compliance strategy. And if I can move to the next slide. Thank you. So just to focus for a moment on the specific supply chain due diligence rules under the CSDDD. As I mentioned, this is the horizontal instrument which sets out the general due diligence rules for large EU and non-EU companies which meet certain thresholds of EU turnover. It has already entered into force earlier this year, but as it is a directive, it has to be implemented into member state domestic legislation. This implementation must happen by 26 July 2026, but it will not immediately become applicable. The application will be gradual and will start in July 2027 and then 2028 and 2029, starting with the biggest companies. Overall, it is expected that around 900 non-EU companies will be covered by the CSDDD, but of course, more companies will be affected to the extent that they are part of the supply chain of the covered companies. The CSDDD imposes due diligence obligations with respect to the actions of the covered companies, but also their subsidiaries and business partners in their chain of activities. Now, this is a new concept which has been introduced by the CSDDD, which covers both upstream and downstream business partners. And this is different approach than that taken under other EU due diligence rules, which typically impose obligations on the companies themselves and on the upstream. Here also downstream activities are relevant, but to a certain extent they are limited only to the distribution, transport, and storage activities of business partners which carry out these activities for or on behalf of the covered companies. Now moving to the specific obligations, which are on the next slide. So it is not possible to discuss all due diligence requirements under the CSDDD in the context of this webinar, but broadly speaking, the different due diligence steps under the CSDDD follow the approach under the OECD guidelines or the UN guiding principles. Today, I would like to focus specifically on one aspect of due diligence, and that is the measures that must be taken by companies to prevent or to mitigate adverse impacts. Now, the CSDDD provides for a non-exhaustive list of such measures, and they are quite broad, and they range from developing prevention action plan or requiring contractual assurances to more far-reaching actions such as investments in production facilities and infrastructure, or even modifications to business strategies, including purchasing and distribution practices. A particularly interesting type of measures that may be required is collaboration with other entities. Here, the CSDDD recognizes that there may be certain circumstances where a company does not have sufficient leverage over its indirect business partners to address relevant risks to environment and human rights. And in those circumstances, it may be appropriate for that company to collaborate with other companies in order to influence the behavior of the relevant business partner. This type of collaboration may raise certain concerns from a competition law perspective, for example, and this is something that will be discussed by my colleagues in the second part of this webinar. It is also important to note that the disengagement or decoupling is considered as a measure of last resort, which should normally be avoided. Before deciding on suspending or terminating a particular business relationship, companies must first consider whether this would not lead to even more severe adverse impact on environment and human rights, and in those circumstances, they should refrain from disengagement and rely on other types of measures that they may take in order to influence the behavior of their business partners. And this brings me to the issue of enforcement. Under the CSDDD, there are in a sense 3 different levels of enforcement. There is the administrative supervision by member states' competent authorities. So the enforcement is decentralized and it happens individually in all EU member states. The competent authorities may request specific information and they may carry out investigations with respect to covered companies. If the competent authority finds non-compliance, it will first request the company to take remedial actions and then may order it to stop relevant infringement or provide remediation. It may also impose fine and in case of persistent non-compliance, publish the name of non-compliant company, so that also brings certain reputational risks. The second level of enforcement relates to civil liability for damages under domestic legislation of each EU member state. This relates to damages which are caused by intentional or negligent actions of a company. And here, importantly, a company cannot be held liable if the damage was caused only by its business partner in its chain of activity. And finally, at the company level, there's a complaint procedure. The CSDDD requires companies to set up a complaint procedure which allows persons that are affected, but also trade unions or civil society organizations, to submit a complaint directly to a company. The company is then required to examine that complaint, and if it is well-founded, take appropriate measures, including remediation. Here again, the companies may opt to participate in joint complaints mechanisms, which are established by other companies or through industry associations. So again, there's this element of collaboration with other companies in order to comply with the due diligence obligations. In the original CSDDD proposal, there were also provisions relating to directors' responsibility, but these provisions have been scrapped in the process of negotiations of the final text, and they are not included in the final text. So the enforcement and the responsibility is limited to these 3 different levels, as I just described. And with that, I will pass the floor back to Samir.
Thanks. I was just thinking about how within the US, we don't have these very specific supply chain due diligence measures that are being put in place on such a broad level. Ours in the US are very specific to different sort of regulations and acts. And, it's a good segue right into the UFLPA, or the Uyghur Forced Labor Prevention Act. Because the UFLPA obviously took effect in June 2022, it had a dramatic impact on the trade landscape and how companies had to look at their supply chain and really conduct diligence on where their products are coming from and the inputs that are into those products. This was passed by Congress in response to certain what they felt were crimes against humanity committed by the government of China against Muslim Uyghurs and other minority groups in the Xinjiang region. Right now, that it requires customs to apply a rebuttable presumption that goods from the Xinjiang or the XUAR region are made in whole or in part by forced labor, and so they must be barred from entry into the U.S. Now, what does that mean by a rebuttable presumption? Essentially, if they feel like goods are coming from Xinjiang and they will be stopped at the border at customs in the United States, and it is incumbent upon the importer to rebut this presumption. It's not that the customs has to provide evidence that it comes from Xinjiang. It's more like the importer has to provide evidence that it didn't. It applies not only to goods that are directly from the Xinjiang region, but also that transited through the Xinjiang region, or where they were transshipped from Xinjiang to another country and then made its way into the United States. Again, it's even if the goods temporarily were in Xinjiang just for a short period of time, that creates this rebuttable presumption. And also, this is where sort of transshipment concerns become critical, because customs has identified other countries such as Malaysia, Vietnam, Thailand, India as prominent transshipment destinations for goods made from Uyghur forced labor. The BIS, or the Bureau of Industry Security, which is a sub-agency under the U.S. Department of Commerce, has created a UFLPA entity list, which is helpful for identifying companies that are actually located outside Xinjiang, that participate in those state-sponsored programs and perhaps employs Uyghurs and other minority groups beyond Xinjiang or Northwest China. And so that's a good place for companies to start when they're looking at sort of their supply chain and seeing where these goods are manufactured and where they're being transited through. The customs also put together a high priority sectors initial list back in 2022. Now, just to be clear, the statute doesn't limit enforcement to these enumerated sectors. It's just saying that customs has significant resources dedicated to enforcement against these sectors, but they have obviously explored enforcement against other sectors as well. That initial list was the apparel, cotton and cotton products, tomatoes, and downstream products from tomatoes, and silica-based products, including polysilicon. Now these, and then in 2000, just recently, earlier this year, there was an update to that list where they added PVC products, aluminum, and frozen seafood. Now, these sectors have been identified because they are produced in significant quantities in Xinjiang, and they seem to make their way into supply chains that flow into the United States. And now I have some stats that pretty much show exactly how large of an issue this is. So since the end of August 2024, there have been sorry, I think that's August 2023. There have been 9,475 cargo entries valued at 3.52 billion that have already been targeted, not denied, but targeted pursuant to the UFLPA. They show that it's almost half of them, almost 47% of them were eventually released, meaning they were found not to be linked to forced labor or even Uyghur forced labor. But this shows how even products that you don't believe are subject to this law can still be stopped. I mean, if you think about half of them were detained and then ultimately released, that means they're getting a lot incorrect. But again, because of this rebuttable presumption, and because it is incumbent upon the importer to provide evidence that they were not created using forced labor, customs can stop these shipments and detain them for a period of time while you put together the arguments for why it wasn't created using forced labor. Now, these high priority sectors are the ones that we listed here, are well represented in the different statistics. The top 4 industries that are experiencing stops due to the UFLPA are the electronics industry, the apparel, footwear, and textiles industry, the industrial and manufacturing materials industry, as well as the agricultural prepared products industry. So what does this all mean for us, right? How do companies navigate this UFLPA? The first one is rigorous and thorough review of their supply chains through supply chain tracing, or otherwise known as mapping. Often this can be done not only by the importer themselves or by third-party companies that have developed processes as well as software solutions in order to map the supply chain of different products. Now, why are companies doing this? Mapping tells us not only what goods are manufactured and what inputs are commingled to create the finished product, but also how a good has been transformed at each stage in the production process. It helps identify avenues for supply chain optimization. It tells us who is transforming goods at each stage in the production process, the conditions in which the product is, the work is being done, and most importantly, where goods and inputs are sourced. This alleviates CBP's focus on goods in Xinjiang if you can show that goods are being inputs are being created in other countries. So from an importer perspective, a lot of these mapping processes include reviewing purchase orders and payment records and mining records, manufacturing records, shipping records, invoices, receipts, etc. Oftentimes there are supplier lists with names, contact information, and roles with affidavits verifying the information that you provide. This all fits into a neat package that you provide to customs should there be an issue with the goods being stopped at the border. There's also obviously supply chain management, which we've sort of gotten into, but it's also about vetting your suppliers on an ongoing basis, using contract clauses that reserve the right to terminate contractual relationships, et cetera, et cetera. The next strategy in terms of maintaining awareness, there are a number of NGOs and other academic institutions that provide data on UFLPA enforcement. One of the ones that many companies use and that we use is the Helena Kennedy Center for International Justice at Sheffield Hallam University. They provide reports on companies and supply chains that have risks for being involved with forced labor, both in Xinjiang as well as elsewhere. It's often cited as a leading resource on information pertaining to forced labor issues. Not only do we often cite that when responding to customs inquiries, and we use this as a due diligence mechanism to determine whether or not there are risks associated with supply chains. So that's certainly a very good place to look. And then, the last part is this idea of preparing for detention. This is sort of a two-pronged approach, where often you have communication and appropriate sort of communication with CBPs, CEEs, the Center for Excellent Expertises about high-risk importations, and also have an alternative supply chain a diverse supply chain necessary should issues ever arise. So I just wanted to briefly touch upon withhold and release orders, simply to say that this is a second area within customs that, as it relates to forced labor issues, that is outside of UFLPA. UFLPA is obviously a much more rigorous statute and a much more rigorous rebuttable presumption to overcome. But WROs are also used by customs to detain merchandise suspected of being made from or of forced child labor or prison labor, right? Essentially, products are being imported. If they're subject to a WRO, the importer must demonstrate proof of admissibility by showing that the producer or suppliers use no forced labor to manufacture the goods, all the way from raw materials and final assembly. It really differs upon what the WRO is targeting. They do see customs does publish its WROs and findings online. Currently, there are 51 active WROs and 8 different findings. For example, there's a WRO issued against raw sugar and sugar-based products from the Dominican Republic, gold from the Democratic Republic of Congo, and many others. Like the Sheffield Hallam report, there is a helpful resource online called the List of Goods Produced by Child Labor or Forced Labor, which is maintained by the Department of Labor's Bureau of International Affairs. I think that's it for now. I'll go on to the next one. Back to you, Joanna.
Many thanks. It's fascinating to hear how it works in the US, because I feel like in that specific sphere, the EU is a little bit less advanced. So the rules look a little bit differently. And to start with, actually, the EU forced labor regulation has not yet been fully adopted, so it's not yet in place. But we already have the final text, which has been negotiated between the EU institutions and which has been formally adopted by the European Parliament earlier this year. It is now waiting for the Council, so the institution which represents the EU member states, to adopt the text, and then it will be published and will enter into force. That being said, we'll still have to wait for the actual application of the law. It will happen 36 months from the entry into force, which means that in practice, the forced labor products ban will most likely become applicable in the EU only in Q4 of 2027. Now, the forced labor regulation essentially prohibits placing and making available on the EU market, meaning import and selling in the EU, as well as exporting from the EU products which are made with forced labor. It applies to all economic operators and to all products, including components, regardless of the sector on the origin. So unlike under the UFLPA, it does not introduce an import bans on products which originate from a specific region or a specific country, company, or industries. There's no list of relevant entities under that regulation. That being said, the regulation foresees for the European Commission to create a database with information on forced labor risks in specific areas and relating to specific products, as well as indication of specific sectors in specific geographic areas for which there is evidence of forced labor specifically imposed by state authorities. This database will be publicly available, and the information included in that database will be used by the relevant authorities for the purpose of applying the ban. So, well, in principle, the regulation applies to all products of all origin. In practice, it is very likely that it will be focused on products from specific regions, such as Xinjiang. So in that sense, there will be probably certain similarities with the approach taken in the US. If we can move to the next slide. Thank you. Now, enforcement is another element which is different in the EU than in the US. Unlike under the UFLPA, in the EU, there is no presumption of forced labor. So it is the responsibility of the competent authorities to prove the existence of forced labor with respect to a specific product before being able to take any action in relation to that product. It is both the European Commission and the member states' competent authorities that have the power to investigate the existence of forced labor. In essence, the Commission will be the lead authority in case of suspected forced labor taking place in third countries, while the member states' competent authorities will be in charge of investigations of suspected forced labor that takes place within the EU. The investigations will be separated into two steps. The preliminary phase of the investigation, in essence, during that phase, the authorities will require economic operators to provide certain information relating to their due diligence actions. And on the basis of that information and additional assessment, the competent authority will decide whether there is a substantiated concern of a violation of the forced labor product ban. If there is a substantiated concern, the authority will then initiate a fully fledged investigation in respect of relevant products and relevant economic operators. This investigation may again involve additional requests for information and in exceptional circumstances, field inspections, including in third countries. The investigation should normally be completed within 9 months, and they will lead to a decision, including decisions to prohibit a placing on the market or in order to withdraw a product which is already on the EU market from the market. This decision will be then communicated to the relevant economic operator, but also to the customs authorities that will play a key role in the enforcement at the border. So the customs authorities, based on the decisions received from the relevant authorities, the Commission, or the authorities of the relevant member state, will carry out controls at the border of the products entering or leaving the EU, and if necessary, we will block that product subject to the relevant decisions and ultimately dispose of those products. In the EU, there is also an interesting exception for goods of strategic or critical importance, so something that I understand does not exist in the US. How it works in practice is that the lead competent authority may decide not to order disposal of a product which was made with forced labor in order to prevent disruption of supply chain of strategic or critical importance to the EU. And in those circumstances, in order to order disposal of the product, the authority may decide to withhold for a limited period of time the relevant product in order to give the relevant economic operator a chance, a time to eliminate the forced labor from the supply chain. Now, there is no specific list of products which are considered as being of strategic or critical importance to the EU, but the regulation includes a reference to other pieces of legislation, including the Net Zero Industry Act and the Critical Raw Materials Act, which then in turn provide list of relevant industries, and this includes batteries and solar and wind energy. So in practice, with respect to these products, even if they involve forced labor, they may not be disposed, but they may be withheld. And then eventually, if the forced labor is eliminated from the supply chain, they may find their way to the EU market. Now, the Commission is still to issue several implementing acts and guidance. So again, in the EU, it is quite early on in terms of forced labor regulation. So this is certainly something that should be monitored. And even though the implementation will only happen in a few years, it is important, given the far-reaching consequences of this regulation, to already start preparation for compliance. And maybe just a few more words on the compliance and the strategy, which is in the next slide. So first and foremost, and this is something that I mentioned earlier, in the EU, it is really important not to focus on individual pieces of legislation, but to look at all this different set of due diligence supply rules together to assess internally which rules are applicable, how they interact with each other, and how companies may streamline compliance. Then again, the monitoring of the developments in terms of additional rules, which will be announced in the coming years and months by the Commission and the Member States authorities. In terms of specific actions that should be taken by the companies, It is first collecting the information, for example, for supplier questionnaires in case of CSDDD, also from customers, and screening suppliers in order to understand what are the relevant risks, where the risks lie, and then based on that assessment, adopt relevant risk mitigating measures, which may take many different forms, including cooperation with other companies, but also capacity building with SME suppliers, investment, changes to production processes, etc. It is also important to keep records of due diligence processes and specific actions that have been undertaken. This type of information may be requested by the relevant authorities in the context of investigations, both under the CSDDD, but also under the forced labor regulation. And finally, review contracts with your suppliers. Consider adding specific information sharing obligations and clauses relating to conditions of production and use of products and services. So this, in a nutshell, provides a few tips, few ideas of how to approach compliance in the EU, where the landscape, regulatory landscape, is quite complicated. There are really many different pieces of the puzzle. But I think with that, we may stop the trade part and hand over to Mark and Andreas, who will talk about the antitrust considerations.
Thank you, Samir and Joanna. Next slide, please. So Andreas and I are going to talk about and compare and contrast the antitrust and competition rules applicable to ESG initiatives in the US and in the EU. And we're both going to start just briefly with an overview of the framework in each of those respective jurisdictions and how it may apply to ESG initiatives. In the US, the antitrust rules are broad and somewhat vague, frankly, but they've been applicable to conduct in the business world for about 135 years, namely the Sherman Act. And the Sherman Act is the same law that applies to ESG initiatives as well. The Sherman Act covers both unilateral conduct and joint conduct. And under the US antitrust laws, unilateral conduct is generally permissible, with the exception being monopolization, which is not really applicable much to the ESG, I don't believe. But so we're going to focus more on Sherman Act Section 1, which talks about joint conduct. Sherman Act Section 1 says that contracts, combinations, and conspiracies and restraint of trade or commerce are illegal. That's the same wording that's been in the statute since 1890, and it is a little bit vague. What's restraint of trade mean? So restraint of trade under the law that's developed in the last century or so means unreasonable restraint of trade. Again, kind of vague, right? But there's a lot of case law about what that means. Generally, conduct in the US is judged with respect to Sherman Act Section 1 under what's called the rule of reason. There are a few types of conduct that are carved out for what we call per se liability, meaning it's so obviously anti-competitive that we don't go into a full-blown analysis under the rule of reason. And those are things such as price fixing, market allocation, and bid rigging. But under the rule of reason, generally, it's often more complex, but generally it requires a balancing of the pro-competitive benefits of a restraint versus the anti-competitive effects of the restraint. And many ESG goals can satisfy this standard. Many ESG initiatives, although it requires, because it's joint conduct, requires careful planning and consideration. But if there's an incidental effect on competition, such as sharing best practices, voluntarily adopting or voluntarily complying with certain standards or certifications, it probably can pass muster under the rule of reason, but does require careful consideration. It requires careful consideration because all competitor collaborations under US antitrust law carry antitrust risk. You're sharing information among competitors. If you are engaging in conduct that your competitors are also engaging in, there's always a risk that the government or a private plaintiff could look at that conduct and look to see if there's some kind of agreement that has an adverse effect on competition. Competitor collaborations in particular draw scrutiny from not only the antitrust agencies but private plaintiffs, but the antitrust agencies do have detailed guidelines in place for the past couple of decades guidelines for collaborations among competitors that can govern how competitors interact with each other. Next slide, please. There is no ESG exemption in the U.S. to the antitrust laws. The Department of Justice and the FTC have both been quite clear about this. And that being said, there have not been many, if any, enforcement actions taken by the government in the last several years related to ESG. The Department of Justice did launch an investigation back in 2019 related to auto emissions standards and whether some of the auto companies in the US were agreeing to environmental standards that were stricter than the federal law, which in theory could result in reduced output or higher prices to consumers. The investigation, though, was closed without any settlement or suit. And I've not heard of any other enforcement actions by DOJ or FTC in the ESG arena since. State AGs have issued several letters and launched some investigations related to ESG issues, mainly focused on climate-related initiatives such as auto emissions and just emissions generally. But it seems that the issue has mostly been a bit of a political football in the US, with state AGs on one side of the aisle saying one thing and state AGs on the other side of the aisle saying the opposite. I won't say too much about the Noor-Pennington doctrine, which you see there on the slide, but just suffice it to say at this juncture that petitioning the government for ESG-related action is protected from antitrust scrutiny. And that would include things like lobbying, public relations, and the like. So if you're engaging in joint conduct with your competitors to influence governmental action, that conduct could be immune from the antitrust laws. And finally, before I turn it over to Andreas, there are some ways to seek informal guidance about ESG initiatives from the Department of Justice. You can ask for what's called a business review letter. The DOJ does not need to respond to that. They can decline your request for guidance. It's also not really binding on DOJ. It only is it's a statement that basically tells the parties, here is DOJ's current enforcement intentions with respect to this topic. But they still retain jurisdiction in any case that they could investigate the conduct at issue. So it depends on the circumstances whether you would want to actually seek that kind of guidance, but obviously there's good reason to be generally reluctant about proactively going to the DOJ to tell them what kind of conduct you're contemplating. So it's something to be thought through carefully before you do so. So that's sort of the US antitrust framework applying to ESG in a nutshell, and I'll turn it over to Andreas to tell you all about the EU.
Thank you, Mark. So to walk you very quickly through the situation on the EU side. So as a starting point, the basic legal framework is pretty much the same as under Section 1 Sherman Act. So if you have a collaborative arrangement towards certain sustainability goals, or largely equivalent to ESG goals, there will be a question whether that arrangement is compliant with Article 101. Essentially, a similar norm like Section 1. What is important to mention, and it will become clear on the next slide, perhaps a more structured analysis on Article 101 with a more separate question: does the arrangement restrict competition, i.e. lead to higher prices, reduce output, limit innovation? And then a more separate question: are there countervailing benefits, efficiencies that outweigh any harm, with essentially a checklist to see what type of benefits there have to be, including to make sure that consumers of the product, of the service that are subject to this arrangement actually also participate in these benefits. So that in principle is very similar to the US situation. Now, to explain the current legal framework in the EU, I think it's also important to appreciate that the enabling environment, the political environment, has been very different in the EU for a couple of years. You heard from Joanna the maze of new regulation that's coming out of Brussels to encourage companies to comply with ESG goals. So there's less of a blue state, red state circus in the EU than we've seen in the States. So that included also for many years encouraging the private sector to think about initiatives, how they could collaboratively reach, promote certain ESG goals, sustainability goals. And often the reply from the industry was, yes, we would like to, we want to individually, but we also want to collectively find ways to promote sustainability goals. But we can't because of competition law. Because if you do, there's always the risk that we might violate Article 101, and that can become very expensive. So you cannot go to jail, but the fines for a violation can be very, very significant. And that was interesting because it led to sort of a not very harmonized reaction with some competition authorities at member state level. So in the EU, you have competition authorities in Brussels, but then also in the member states who then enforce national, but also EU competition law. Some of these national competition authorities participate in debate and saying, especially climate change is such an important societal goal that we realize that we must make sure that competition law does not stand in the way of collaboration, and therefore send out a signal saying, if you come to us with a collaborative arrangement that credibly pursues sustainability goals, again, primarily also in the area of climate, fighting climate change, come to us, talk to us. We will be willing to apply not only the traditional competition law analysis and look at direct efficiencies, but we will be willing to take into account much more broader benefits in terms of contributing effectively to the fight against climate change. Other competition authorities said the opposite. They said, oh no, we are staying out of this. We don't have the power, we don't have the expertise to engage in this sort of balancing of various societal goals. We are not the ones to say, fine, the products may become more expensive for our consumers, but we take the benefits to the entire world or to the next generation of consumers into account, and we weigh these benefits and decide that it's fine to restrict competition. That's not our task. We are competition enforcers. If there's a need to encourage industry collaboration, that has to be done through regulation and not through us competition enforcers. If you get to the next slide. So that was the general debate. All this happened at a time when the European Commission also had to update its competitor collaboration guidelines, the guidelines for horizontal agreements. And that prompted the European Commission also to include a new chapter in the guidelines just on sustainability agreements, collaborative arrangements to reach sustainability goals. It's a very dense document, about 20 pages, single space, laying out basic principles of how the Commission intends to enforce competition law when it comes to agreements, to collaborative sustainability arrangements and agreements. And it's very useful. I think that the general gist is that the Commission, for agreements that arguably restrict competition, arrangements that may lead to higher prices, for example, because you use higher recycled products, you use products that are produced with lower emissions, they tend to be more expensive. So if you have an arrangement that may lead to higher prices, the Commission stays more on the traditional side, essentially saying, okay, if the arrangement likely will lead to a restriction of competition, we would analyze the benefits under the traditional framework. We would ask whether consumers are better off, for example, because of higher quality, whether the consumers of the product are better off because the value, the inherent benefit of the product, of being produced with fewer emissions, being produced without forced labor. But generally, these wider global benefits, those cannot be taken into account in a competition analysis. So that's one part, but I think it's important that the guidelines are very useful, because what they do, perhaps even more importantly, is they point out that there can be many arrangements that probably will not raise material competition law risks. So information exchanges between companies about the internal ESG measures, joint lobbying with the right rail guards, benchmarking, all these exercises likely wouldn't even raise a question under Article 101. The guidelines also have very important, section on standardization, sustainability standards. So creating of sustainability labels, under what conditions industry should be able to commit to creating labels, to adhere to labels in a way that doesn't raise competition law concerns. So I think that's sort of a very short, high-level summary of the guidelines. A traditional approach, there's no separate competition law for sustainability agreements, but if looked at it the right way, there are many ways in which industry can collaborate without running competition law risks. I think it's also important to set the scene that in Europe, there have been also good examples of how collaboration can go wrong. So, but the Commission would then label green cartels, anti-competitive agreements that sort of seem to deal with sustainability related topics, but then go off in the right direction and actually restrict competition. So the most well-known example is the German car manufacturers entering a discussion about AdBlue. That's an additive for diesel engines to lower the emission of nitrogen dioxide. And you cannot blend this into the diesel. It has to be separate in the tank in the car. And so this discussion about AdBlue then led the car manufacturers to agree on the size of the tank, essentially limiting how far you could use one tank of AdBlue. And the Commission discovered this, and this became a cartel that ended with about 800 million euros fines. So you have both, you have already clear indication where collaboration can go wrong and in which circumstances, but also I think a very significant encouragement by competition enforcers for companies to consider how they can enter into arrangements that further sustainability goals. Should we get to the next slide? Yes. So Mark and I thought we just conclude our discussion and check what this actually means in terms of, so the framework Mark described, the framework I described, what this actually means in terms of practical compliance measures. And we thought it's easiest to explain if you look at a quick hypothetical, right? So assume you have large importers of fruit that agree with an NGO on the creation of a label, and the label certifies that the fruit comes from producers that provide for fair wages, for fair working conditions. So that's the first step, creation of a label in relation to ESG goals. Now then the producers go further and say, okay, we create a database of the producers that meet the certification. So it's easier for us to decide where we can source our product. And then in the database system, they even identify which supplier is related to which importer. And then going further, they also would commit then that within a certain period of time, say 2 years, they will purchase all their fruit, source all their fruit only from producers that are certified under this label. So that's a not so unusual attempt to use labels and certification requirements to encourage sustainability efforts. And this hypothetical, I think, will allow us to see how competition law would look at this. Mark, do you want to get a start perhaps on that?
Yeah, sure. Thank you. So under the first bullet there, I would say the first issue that I see under the US laws is it clearly says that these 3 fruit importers are agreeing with an NGO. So at a high level, as I mentioned before, joint conduct is viewed differently under the antitrust laws in the US than unilateral conduct. So if this had been an NGO, for example, that unilaterally issued some standards that would result in some kind of certification, and each importer were deciding on its own, independent of the others, whether to meet the certification levels that were promulgated by the NGO, there'd be no joint conduct issue, or at least there'd be less of a risk of a joint conduct issue. So that's the first thing that I see, Andreas. I don't know whether that sort of that difference is similar to what how the EU would treat this.
That's obviously right. So once you have this joint action, you do have to look at competition laws. I would say at this point, if it's just the label without any of the other additional factors like agreement to mandatorily comply with the label, to source only from certified producers. If there's nothing else, it's just saying we create a label for the industry, that probably in the end you would say should not be a material competition law risk. But because you have the joint action, you would at least have to check whether there could be any antitrust risks. Yes.
Mm-hmm. And the database idea, I would say that this could implicate certain concerns about sharing information among competitors in the US. While sharing information itself is not illegal under the US antitrust laws, certainly sharing competitively sensitive information about your suppliers with your competitors could be evidence of an antitrust violation, or at least could result in increased scrutiny, but is not itself illegal. And I don't know, Andreas, whether that's also consistent with the EU.
Right. I think that the second point we put in to highlight that, yes, you can. There are ways to collaborate in this and in other ways, but you need to really carefully watch the conditions under which you collaborate. So probably, again, a database just to provide producers the opportunity to show to potential buyers that they are certified in itself would probably not be a particular risk. But as Mark pointed out, once you add here that each import identifies from which supply it sources, then you immediately get into a risk zone because you would share potentially sensitive information about your own business conduct. So the story is, again, yes, it's possible, but you need to keep from the outset an eye on competition law to make sure that the way you set up your collaboration doesn't unnecessarily get you into a high risk zone.
And I've only got a couple minutes left, but the last point that I think I would raise relates to the last bullet, because this looks to me like what under US law could be considered a group boycott situation, where the producers or the importers are agreeing to only use certain suppliers, and they're all agreeing by doing that, they're also agreeing necessarily to exclude other producers. And once you can unilaterally decide under US law who you want to deal with, and there's nothing that says you have to deal with any particular producer, but once you agree with another entity or multiple entities to exclude certain producers, that could run afoul of Section 1 of the Sherman Act, because it would, I guess in theory would be that it would reduce output and potentially raise prices downstream.
Yeah, no, that's correct. I think it would be the same in Europe, that going back to the first bullet point, the Commission is very explicit saying labels standards is fine, but they must be voluntary. So adherence to them must be voluntary, or you can mix, right? You can use some here, some without the certification. But with the commitment to comply with certain standards, you get into the joint boycott area. And also you increase the effects of the label, right? So presumably the prices of fruit, certified fruit, would already be higher. And if you then have a commitment of all 3 large importers to source only certified product, then you would also be much more concerned about the likely price effects that would have for consumers. So again, very similar analysis, very similar concerns. Again, the point, there are legitimate and compliant ways to set things up, but always with an eye to keep elements out that would then probably run afoul the competition laws.
Yeah, and I think, Andreas, that it's probably safe to say that the US and EU laws are similar enough that harmonizing them, well, it's important to harmonize them for sure, but it's also possible to harmonize them even when you've got these sort of multi-jurisdictional initiatives in place.
Yes, and I think, and conversely also, even though the EU framework seems to be more permissive or is more encouraging to collaborate, in the end, I think the basic safeguards that you would have to have in place, right, to make sure you avoid information exchanges, exchanging sensitive information, you avoid joint boycott arrangements and so on from the outset. That all is very much similar, and you can pretty much have a global compliance strategy to be sure you're on the safe side in both jurisdictions. Yes. So maybe we wrap it up more quickly with.
I think that puts us up against it. Just quick takeaways. These have all been mentioned in some way or another, but voluntary initiatives are generally less risky than mandatory ones. Unilateral conduct generally less risky than joint conduct. And putting a procedure in place, compliance procedure, policies, practices, training in place will help if there is ever scrutiny on any kind of initiative. And obviously, to help with this, you should consider engaging experienced counsel to be sure that these safeguards are put in place.
Right. So in many ways, you don't treat sustainability arrangements in any way different than other collaborative arrangements. That I think is the baseline here.
Yep, so I think we're a couple minutes over. Samir?
Sure. We do have a couple questions, although I think we can respond to them over email or get back to people over a call in the interest of everyone's time. So thanks again, everybody, for attending today's webinar. I did note at the start that the program was recorded, and so we'll send a link to all the attendees within 48 hours of today's presentation. Again, if you have any other questions or anything at all, please don't hesitate to reach out to any of us, to any of the speakers at any time. We're happy to discuss. And if you're not currently receiving updates or invitations, both Thompson, Hine, and Van Bell and Mellis have websites where you can receive our mailings under publications tabs. Again, thank you all for your interest in attending. Enjoy the rest of your day. Please be well. Thanks, everyone.
Thank you.